Hello everyone, how's it going? Welcome to my channel where we talk about the most interesting topics in the market. In the world of investing, people are often asking themselves how to profit from the next big thing, how to accurately seize the opportunities before they become widely known, and how to make predictable and secure income streams. It is precisely to answer those needs that entities such as SCHD have been created. It is an exchange-traded fund that correlates with some of the world's most famous and successful companies and distributes dividends from the stocks that are listed within its assets. To a large extent, the Schwab US Dividend Equity ETF chooses from the safest and most stable industries and brands in our economy to invest in the long term. Perhaps another reason why SCHD has attracted so much attention from the market participants is also its very bullish price action since the inception, as well as its dividend track record. Over the past 5 years, despite strong economic headwinds, the Schwab ETF managed to increase its share price by almost 50%, which is, in that regard alone, very impressive and has beaten many of the more riskier counterparties. If we go back as far as 2011, when first began trading, SCHD increased by more than 183% since it began, which really shows how far the stock has risen. And before the video begins, if you would like to see more stock analysis videos like this one, please consider to like, comment, and to subscribe to my channel. So in recent days, the ETF has maintained its position around $76.12, indicating a 4.3% increase compared to a month ago and 5% uptick over the past 6 months. It has rebounded impressively by 14% from its October 2023 low point, recovering from around $67 and maintaining that tendency ever since. Zooming out for a broader perspective, SCHD displayed lateral movement throughout the year, concluding just 0.5% higher than about a year ago. Despite this, the stock has gathered attention, albeit lacking compelling catalysts to drive it to higher levels. This cautious optimism is particularly noteworthy given the prevailing downward pressure on equity prices and signals of a potential economic downturn. With a modest expense ratio around 0.06%, SCHD offers a convenient avenue to hold a diversified portfolio of over 100 holdings in the US stock market, boasting well-known names like AbbVie, Texas Instruments, and Broadcom. Investors in this ETF gain exposure to key players in the American economy through a single investment. Highlighting its emphasis on dividend stocks, SCHD remains a steady choice even amidst historically high inflation, presenting an appealing risk-adjusted yield of approximately 4%. With a consistent track record of increasing dividends over time, SCHD distinguishes itself from other safer investment options, providing more than just a competitive yield. Given the ETF's popularity amongst both institutional and retail traders, this adds an extra layer of interest, especially with expectations of key interest rates either stabilizing or decreasing. This widespread appeal holds the potential to fuel compelling upward movements in SCHD's price. Therefore, keeping a keen eye on SCHD is highly advisable as it navigates through these dynamic market conditions. With that being said, here's a quick look at the technicals. The trading volume of Schwab US Dividend Equity has recently been around 4 million shares, to an average volume of 4.4 million shares. Over the previous 52 weeks period, the price fluctuated between $66.67 and $78.23. The volume of shares traded tells us how many shares have been bought and sold at any given point in the market, and also if there's enough liquidity to support a trading strategy. If the float is thin, it would be easy to influence the stock price, but low liquidity can mean that the demand would be limited as well. When we compare the current volume against the average volume, There might be the possibility for trend reversal or breakthrough if the difference is very large as well. Now, for instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The assets under management for Schwab US Dividend is currently at around $52 billion. As we compare the current price to the historical price fluctuations, the stock is 6% higher than the 1-month low, 14% higher than the 90 days low, and 14% higher than the 52 weeks low. On the options market, which often gives a hint about the market sentiment of where the stock might go next, the implied volatility is 12% compared to a historical volatility of 11%. Now, the put-call volume ratio is currently around 112%, meaning many people expect Schwab to eventually go lower, probably due to its historically high level. And it's also normal for many stocks to also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 1.1 thousand contracts a day versus the 30-day average of 2.2 thousands. Regarding open interest, the most recent volume of open interest is 61,000 contracts versus the 30-day average of 60,000 contracts. Regarding the shareholder structure, institutional shareholders own 40% of the outstanding shares, the biggest shareholders including Charles Schwab, Bank of America, and Morgan Stanley. Usually, it is better to see institutional presence in holding a stock or an ETF long term because it offers a layer of stability and a token of trust and reliability in the medium to long term future. It means that the market believes that this equity or ETF has value and can truly deliver what it promises in the long run, which is an important factor to consider for investment and not just trading. Personally, I do believe that a threshold of minimum 30% would be advisable, but of course, there are exceptions. The current short interest is around 874,000 contracts in the total float, 40% of which comes from the dark pools. Typically, if the short interest is above 15% of total volume, and a lot of it comes from the dark pools, there would be an argument for short squeeze. With that being said, the current short interest is far too low to qualify for that kind of threshold. So this is why I don't believe that there's any sort of purposefully shorting operation going on. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. So, my recommendation overall is to gradually build up a position of SCHD over an extended period of time. The potential decrease in interest rates may instill renewed confidence in an upward market trend, attracting more capital into equities for yield. However, exercising caution is always paramount given the currently historically elevated market price of SCHD. Despite potential fluctuations, SDHD could function as a dependable, stabilizing element in any long-term portfolio. The recommended capital to commit would be around 10 to 15%, and to also split the allocation in batches of 10 to 20% over a period of time of around 6 months.